All right, well, welcome everybody. Thank you very much for joining. As you may or may not know, we at Blue Chip Partners have been putting on these live webinars for the past few months, hoping to give all of you guys some timely and evergreen information on the world of investment management and financial planning. So before we jump into things today, just a couple housekeeping items. Number one, this meeting is being recorded, so that way anyone that would have liked to join but was not able will be able to watch the replay as it will be posted to our blog. Make sure you like and follow us on LinkedIn to get all the latest content, such as these webinar replays, as well as other investment management and financial planning related topics. And then finally, let's make this interactive. If you have any questions, feel free to use the Q&A function at the top bar, as well as the chat function. Time permitting at the end, we'll look to address any questions that you all may have. And so before we jump into things, a couple quick introductions. My name is Dusina. If I haven't met you already, I'm the Director of Investments here at Blue Chip Partners, also joined by Matt Mondoux, Senior Financial Advisor, as well as Robert Steinberg, Founder and CEO of Blue Chip Partners. So today, to kick things off, we have Matt that will be talking about bond market mechanics. Simply put, why do bond prices move when interest rates move in a certain way? I think this will be a very timely reminder, if not a timely education session for all of you folks that are on the line. After which I will be walking through some current market observations and some views on the path forward before finally turning it over to Robert to discuss some action items, most specifically related to capital gains. And with that, Matt, I'll turn it over to you to start discussing some fixed income market mechanics.
Awesome, Daniel. Thank you. So, want to start off with a couple of visuals here. I think, pictures worth 1,000 words. And in the most basic sense, bond prices and interest rates have this teeter-totter-like relationship, meaning when rates go down, prices often go up, and the opposite's true. When rates go up, prices often go down. And we'll get into some examples of why that's the case. But generally speaking, if you think of a teeter-totter, when you think of rates and prices, that's going to get you most of the way there with understanding how bonds move relative to interest rates. And the next visual I want to go over is just this, and we're going to get into some definitions here, but really at the end of the day, the bond is an investor or lender giving a borrower money, that borrower paying a series of interest payments along the way. And then at the end of a stated term, the principal's returned to the investor, so they're made whole. And for that borrowing, the borrower got to invest in a business and do something that they needed to do with that money. So a couple of quick definitions. At the end of the day, bonds are a debt instrument. Instead of going to a bank, an institution, a company can go to the investing public, issue bonds, and pay interest and raise capital that way. Some key terms, principal, that's the amount that per bond that the company's borrowing, which will be borrowed and then returned at maturity. Maturity is the term or length of the holding period or that bond's life. And then the coupon, that is the amount of interest that the borrower is going to pay the lender, usually on a semi-annual basis. And then two key risks. There's more than these, but two key ones. Interest rate risks. That's the risk that rates are going to meaningfully be different than expected by the holder or the investor of the bond. And then there's also credit and default risk. Those risks tend to rise as we're heading into a recession. And that's really the risk that maybe a company's going to go bankrupt, or in something less than that full principal amount will be returned at maturity. So diving into a quick example here, two bonds issued by a hypothetical company. XYZ Corp issues bonds on January 1st of 22. It's a 10-year term. The prevailing interest rates at the time of the new issue are 5%. The principal value is at $10,000 per bond, so the coupon payment will be $500 annually. Over the next 6 months, rates increase. So XYZ Corp needs to borrow more money or raise more capital on July 1st. Same bond term, 10 years, but interest rates are now 6%. The principal value is the same at $10,000, but that coupon payment is now $600 annually. So what happens now? Well, Bond A and Bond B are issued by the same company, but rates have gone up from 5 to 6%. So Bond A is now inferior to Bond B. Why would you ever get 5% or $500 annually when the market now says you should be getting 6% or $600 in annual coupons? So in order for an investor to be indifferent between the two bonds, Bond A would need to come down in price. So instead of buying the bond for $10,000, an investor would be willing to pay some lesser amount for Bond A. And how do we calculate that? Well, it's a present value calculation that's fairly straightforward with the inputs. We know the future value at maturity will be $10,000. The coupon payments for Bond A are $500 per year. There's 9.5 years left because six months have passed, and the current interest rate environment is now 6%, so up from 5% when that bond was issued. Let's calculate for the present value. This can be done on Excel, but the present value is now $9,291, which is a 7% decline in price. And that's the price that a bond investor would be indifferent between buying Bond B or Bond A. And still, if held to maturity, the investor will get $500 in coupon payments annually with $10,000 returned at the end of that term. So I hope that was a good example to kind of lay the framework for what we're going to talk about, what's happened in the bond market relative to interest rate and prices so far in 2022.
Great. Thanks, Matt. Yeah, I think it really is a perfect segue. When we look at what's gone on in financial markets this year, everyone's been well aware of what's gone on in the equity market. And in periods of steeper declines, generally speaking, investors would expect the fixed income portion of their portfolio to be a bit more of a ballast. That certainly has not been the case this year. And I'll explain a little bit as to why and what we are seeing right now in terms of the path forward. So really what's gone on in the bond market this year has been predominantly driven by inflation. We've all been hearing and experiencing inflation significantly over the last year, coming out of the COVID pandemic that started in 2020. Really, it was an excess of monetary stimulus, a huge amount of pent-up demand, a massive push for hiring and great wage growth, which ultimately led to inflation, or as measured by the CPI Consumer Price Index, reaching levels of 9%. And so you'll see that in the blue line on the chart on the left-hand side of the screen here. Now, this significant inflation, while that alone hasn't caused bonds to decline in value, it's the reaction to that inflation that has been troublesome for bonds. So the Federal Reserve, which is the central bank here in the United States, has a dual mandate. The first is to maintain a full level of employment, and the second is to manage inflation. So while they can't directly move the needle on inflation, what they can do is constrain the money supply, and they can tighten financial conditions, aka increase borrowing costs, and just tighten financial conditions overall. So what you'll see is that the Federal Reserve was quite slow to react to rising levels of inflation. And in more recent months, over the last 6 months plus, they have been incredibly aggressive with raising interest rates. And as Matt alluded to earlier, rising interest rates has a directly negative impact on fixed income instruments. So what you'll see on the chart on the right-hand side of this screen is that, broadly speaking, just looking at a few specific fixed income indexes that span short through intermediate through long term, the returns have been negative. And it's important to note that the bar you see here in gray, that's the longer term bonds. As interest rates move, longer term bonds are more exposed. And so that's certainly been the case this year, as long term bonds have lost more value than, say, intermediate term bonds. Now, just because we have been dealing with this inflationary pressure and this rapidly rising interest rate environment from the Federal Reserve, this calls to mind something that is known in financial services as one of the behavioral biases. Most specifically, this is something that we would see popping up called recency bias. And just bear with me for a second while I get to the point, but recency bias just refers to an investor thinking that what's happening today is going to continue for the indefinite future. And so those current dynamics that are being experienced today, aka very high levels of inflation, rapidly rising interest rates from an overly hawkish Fed, the expectation, and the gut reaction is this is going to happen forever. And financial markets are taking a turn for the worse. Well, I'm here to remind you that many people have been saying these types of things in the past in troublesome market environments. Simply put, these current dynamics will not last forever. We're already seeing indications that this is the case. So when you look at the chart on the left, one thing that I would say we watch fairly closely here at Blue Chip Partners is a break-even inflation rate. And so all this is showing you in the chart on the left, the brown line is showing you what market participants in fixed income are expecting the inflation rate to be on average over a stated period. In this case, it's 2 years. And so while we did start to peak out back in March and again over in June, we've come down significantly since then, to the point where the market is now expecting and pricing in an average level of inflation that is much more palatable, much more close to the long-term target of 2.5%. And so what you will find is that as these inflation expectations come down, this is ultimately what drives the yield on fixed income instruments. So you can see the correlation between the drop in inflation expectations in the brown line and the drop in the 10-year Treasury yield, which is a broadly stated benchmark fixed income yield instrument. And so it's important to note that just because the Federal Reserve will continue raising rates through the end of this year and into next year, at least that's what is anticipated at this point, the fixed income market is forward looking. So just because interest rates will continue to rise, that doesn't mean that bond prices are going to just reflect what's happening today. Bond prices will reflect what's happening tomorrow. And given that we have an estimate for the federal funds rate that will be coming down through the back half of next year, the market is starting to price that in, and that's indicated by declining yields. You can look back through periods of history in which you saw the yields on, say, something like a 10-year Treasury precede actual Federal Reserve interest rate movements. And so I think this is fairly key to note right now, because the bond market is telling us that these current inflation dynamics will not last forever. And while bond returns are still negative for this year, it's fair to note that over the last 2 months, they've regained a fair amount of ground. And certainly the environment as we look over the next 12 months is not necessarily as challenging for fixed income instruments as it was over the last 12. With all that said, I'm going to turn it over to Robert to talk through some action items that we see in play today.
Thanks, Daniel. I'm going to touch a little bit more on how bonds have done, and then focus in on the tax harvesting type of an approach where we can basically take advantage of the losses that we've incurred. This is a chart that really helps understand what the market has been like this year. This chart shows the worst 20 quarters of the S&P 500 since 1990. You can see they're in kind of the order of worst return to the 20th worst return. Also on the chart, you see in the orange portion how bonds perform during that period. So in many cases, bond investments actually did well during periods of low stock market returns. If you look at the chart closely, and again, don't try to get too much into the details, I just want to highlight a couple things on the chart. The second orange bar in from the right shows pretty significant negative bond returns. That was Q1 of this year. And so the stock market was down, but the bond market actually was down even more than the stock market. And if you look over on the left-hand side, the fourth column in, you can see again negative bond market returns. That was the Q2 of this year. So all the way since 1990, bonds have performed worse this year in bad stock markets. So that explains a lot of how we're feeling. In fact, in Q2 of 2022, what ended up happening, that was the only time where the stock market was down over 10% and the bond market was negative. So really what we want to focus on is we've had these negative bond returns. how can we take advantage of them? If you own a bond mutual fund or a bond ETF, it is highly likely that the total amount of your investment, counting the original investment, plus any reinvested dividends, is worth less than the value of your bond today. It's just the way bonds work, especially after you've had a quick spike in interest rates. If you own bonds in a retirement account, 401k, IRA, there's nothing that tax loss harvesting can do to help you. But if you own bonds in a non-qualified account, an individual account, a trust account, a joint account, going to provide some valuable advice that should save you money on taxes. The Cliff Note version is look at your statement and find your bond mutual fund investments and determine which ones are the tax loss. Like I say, I think almost all of them likely will be. Sell those investments. In other words, take the loss, or as I say in the industry, recognize your loss, and then reinvest the proceeds into other bonds that are similar in investment objectives. Put it real simply, if you had a municipal bond fund that's at a tax loss, sell one municipal bond fund and buy another municipal bond fund. You know, assuming same credit rating, assuming same interest rate and same maturity, most people wouldn't care whether they owned a bond issued by University of Michigan or Michigan State University. A few might, but anyways, if you own one and it's at a tax loss, we'd recommend swapping into another bond. Yeah. If you owned all individual bonds, it might be some work to take tax losses. But thankfully, what ends up happening is most investors own their bond investments through mutual funds or bond ETFs. And in that case, in their non-qualified accounts, they may have, you know, anywhere from 3 to 5 different bond investments that can easily be swapped into additional similar bond investments, and then the tax loss can be taken. And again, this does not help for your retirement accounts, but it does help for non-qualified investments. Everyone, no one likes to lose money, but taking a tax loss does feel a little bit better when you're offsetting a gain that's already been recognized. Recently, I was on a airplane. I was sitting in my seat, and a gentleman came on the plane after I'd already been seated, and he had had a couple cocktails, I could tell, and he ended up sitting next to me. And before you know it, we were talking about what I did, and he told me that he was having a great year and he was making, between him and his wife, over $500,000 this year. And I said, well, congratulations, you're in the 35% tax bracket. He goes, well, I guess you would know. And then he proceeded to go on and tell me about this great investment that he had made. He said he had bought an oil stock for $10,000 and sold it for $50,000. And he said he had made a $40,000 capital gain. He was really proud of himself. He goes, I don't know hardly anybody that's made this type of a gain this year. He goes, I'm going to take my $40,000 profit and go and use it toward the purchase of a boat. I said, no, you're absolutely right that very few investors have made money this year, but you probably don't want to spend $40,000. You'd want to spend $26,000 because you're in the 35% tax bracket and you've recognized a $40,000 gain. So you're going to owe $14,000 in taxes. He wasn't really enthused about that. Then I asked him, do you own any other investments? And he said, well, not. And then he realized, he goes, yes, I do own an old bond index ETF that mutual fund that I had inherited from my father. He goes, something doesn't make sense about it, because when I look at the statement, it says that I have a $45,000 tax loss, but he goes, I know it's worth a lot more than it was when my dad died. He goes, I just never followed up on it. I said, well, let me explain it to you. I said, do you pay income tax on those dividends each year? And he says, well, yeah. He goes, that's why my accountant says I don't get a tax refund. I said, well, what's ended up happening is, based on the value of the investment when dad died, plus all the reinvested dividends, your investment is actually down $45,000. He was surprised to hear that. I told him, what you need to do is sell that investment and take the tax loss, and if you really want to stay in bonds, and reinvest it in a similar type of bond investment. He said, well, Dad always liked bond index mutual funds, And I said, well, let me explain it to you further. I said, okay, you've recognized a $40,000 gain. If you sell the investment of the bond mutual fund, you will recognize a $45,000 loss. I said, that's a $5,000 loss. So instead of owing those $14,000 and only be able to put $26,000 toward your boat, you'll actually be able to put the full $40,000. I said, it gets a little bit better than that because you still have $5,000 of loss remaining. What you can do under the current tax law code is you can take 3,000 of those losses and apply those against other income. And in your case, with a 35% tax bracket, you will then save another $1,000, $1,050 in income taxes and still have $2,000 to carry forward. I said, so under this case, you'll end up with $15,050 more dollars than you would have had by not selling investment B. And he said, my dad probably would be okay with that other bond index fund that you were talking about. And I asked him, I go, are you sure that you do not have any other investments? And then he hesitated and said, well, in that same statement, it looks like there might be another bond investment that has a $35,000 loss. And I said, well, you want to take the same approach with that one, sell that one, recognize the $35,000 loss. He goes, wait. He goes, I've already used up more losses than I can use because I already have 2,000 going to next year. I explained that the capital losses never expire and they stay with you until you die. So in this case, you'd have $37,000 capital loss carry forward. And at the minimum, you could take $3,000 off your taxes each year and save $1,000 for 12 years. And then if somehow in the future you had another capital gain, then you can use more of that gain to offset your losses at that point. So I said, there's really not a downside to recognizing capital losses, even if you're not able to use them in the current year. Would have expected at least he would have offered to buy a drink. He didn't, but it was an interesting conversation nevertheless. I want to thank everybody for listening in on the seminar and the webinar, and I'm going to send it back to Daniel for any questions we might have.
Yeah, thanks, Robert. So I didn't see any questions come in, so I guess I'll just pose one myself to you, Robert. This tax loss harvesting conversation, I mean, this is one we have at Blue Chip all the time right now, just given the environment. And is this something that I would say a lot of people utilize right now, or is it kind of a commonplace, or is this something that isn't really seen that often?
I would say typically we'll see where advisors are focusing near the end of the year in order to take tax losses. But what we've done much more proactively is throughout the year, especially with the bond investments, to take the losses as we go. The big thing is if, like for instance, the stock market has recovered this year significantly, if the bond market would follow a similar path, then losses that would be available to us will go away. And we really do not care whether we own bond A municipal bond fund or bond B municipal bond fund. So what we really want to do is take those tax losses so that we can use them against other gains or other income in the future.
Yeah, great. Thanks, Robert. Yeah, that's been a very big priority for us here to strike them while the iron's hot. No one likes to recognize a loss, but when you can make it work in your favor, it's absolutely something that should be considered. Well, I'll echo Robert's sentiment, and on behalf of Robert, Matt, and myself and the rest of Blue Chip Partners, thanks so much for joining. Hope you guys found this informative and insightful. Stay on the lookout. We'll be doing this again on a monthly basis, so looking forward to providing you guys with some more insights into financial planning and investment management in the future.